Why was crude oil trading negative? So today we will be understanding what happened in the market, why crude oil started trading negative, because that is what everyone saw yesterday, and I've been getting a lot of queries regarding this. So I thought, why not to do a quick video to help you understand that why crude oil it started trading in negative. Now, to understand this, let us first understand what is futures. So let's imagine that we have a person called Tom, and he is a farmer, and he farms rice, and there is shortage of rice in the market, and it's still 3 months to harvest. So due to this shortage of supply, the price of the rice has inflated in the last 2 months. So let's assume that the price was 70, but from 70 now it has gone to 100. Now Tom believes that after 3 months the harvest will happen, and that harvest will restore the supply of rice. And since that shortage will be restored, the price can go back and deflate from 100 to 70. So now what Tom wants, he wants to take advantage of this increase in price. So he's interested in locking in this 30 rupees inflation because of his belief that the price will deflate to 70 in about 3 months. And similarly, let's assume there is a person, Jim, and he has a grocery store, and rice is one of the product which he sells on his grocery store. And Jim believes that this shortage of rice will continue, and in the future the prices can even go to 130. From 100 it can go to 130. So because of his belief that this shortage will continue and the rice will inflate, he is interested in stocking as much rice as he can at 100 rupees, so that later when the prices inflate he can sell it at 130. So now what happens is, because Jim is interested in buying and Tom is interested in selling, they get into a contract that let us do a contract that 3 months from now. So Jim believes that the price will inflate, so he's interested, like I said, buying at 100, and Tom will, Tom believes that the price will deflate, so he's interested in selling at 100. So they both get into a legal contract that 3 months from today, Tom and Jim will be exchanging 1000 kg of rice at a price which is 100 rupees per kg, irrespective whatever the price is in the future, right? So what they have done is they have done a contract that after 3 months from today, irrespective whatever the market price would be, Jim would be buying at 100 rupees and Tom would be selling at 100 rupees, and the quantity which they decided was 1000 kgs. So now they both are into a legal contract, and what is going to happen next, that this legal contract will have certain rules. What are those rules? That this legal contract will have an expiry date. Like here you can see that we are talking about 3 months from now. It will also have a specified quantity, like here it is 1000 kg, and also a price. So can you see they opened the contract at 100, so the transaction will happen at 100 rupees per kg. So in some cases the contracts can also have the quality of that product. Example can be in gold, it has to be pure gold. Similarly in rice it can be a specific type of rice, maybe basmati rice, right? So at times these future contracts can also talk about the quality of that particular asset. So let's imagine after 3 months the price they do inflate to 130. So what is going to happen is, because the prices have inflated, Jim can still buy that rice from Tom at 100 rupees. Why? Because their contract was that Tom will be selling at 100 and Jim will be buying at 100. So even though the current market price is 130, Tom still has to sell it to Jim at 100 rupees, because that is what the contract was all about. So what is going to happen is, now Jim is having a profit of 30 rupees, and whereas the Tom is having a loss of 30 rupees. So one person's loss is another person's profit. Now the other thing could have also happened, that after 3 months the prices could have gone down to 70. So in this case what would have happened is that Jim would have been forced to buy at 100 and Tom would have sold at 100 rupees, thereby locking in that 30 rupees which he wanted to do when initially he was expecting the prices to go down. So this is how a future contract works, and that is what a future market is all about. That a future market is a marketplace where participants, they buy and sell a future contract based upon predictions, whatever their expectations is in the future for a specific asset on a specific date. And both of them, they have the obligation. The buyer has to buy, the seller has to sell. They cannot get out of that obligation. They have to fulfill those obligations before expiry or at expiry. No, so now that we understand what is what is a futures contract, not options, I apologize. So now that we understand what is a futures contract, let's move ahead and now understand what happened with crude oil. So if you look at crude oil here, you can see that crude oil, we had the May contracts. Can you see this is the May contract of crude oil on CME. CME is your Chicago Mercantile Exchange, and the settlement date, like I told you, the future contracts, they have a settlement date. That settlement date was 21st of April. That on 21st of April or before, this contract has to be completed. The buyer has to buy, the seller has to sell. They cannot keep it beyond 21st of April. So that was the expiry date. So what happened here? Because the contract was supposed to expire, let's assume that a buyer and a seller, they got into a contract when the crude oil was trading at $20. So when the crude oil was trading at $20, the buyer could immediately sell at 20 without having any profit or any loss. Similarly, the seller could also immediately buy at 20 without having any profit or loss, because they are entering at 20, they are exiting at 20. So at $20, when they are entering that contract, no profit, no loss for either the buyer or the seller. But if the prices, they start going down, let's say the prices, they go to $15. Now what is happening is that buyer is having a loss of $5. Why? Because in the market it is currently available at $15, but he will still have to buy at 20. But if you talk about the seller is now having a profit of $5. Why? Because even though the market price is 15, he can still sell it at 20, right? Which means he's making a profit of $20. Similarly, if the price they go further down, let's say to $10, now the buyer is having a loss of $10 and the seller is having a profit of $10. If the prices they go to $5, now the buyer has a loss of $15 and the seller has a profit of $15. Now the lowest it could go was 1 cent, right? Because everything will have some value, right? It cannot go to zero, so it will have some value. So the minimum a contract can ever go is 1 cent. So if the contract would have gone to 1 cent, then what have happened was that the buyer would have taken a loss of $19.99 and the seller would be having a profit of $19.99. But what happened on 15th of April, you can see the CME, the Chicago Mercantile Exchange, they issued a notice, and that notice said that there is a possibility that certain energy future contracts can trade at negative or zero prices. So what they did was, initially the future prices could never go to zero or they could never go to negative, but they they issued a notice that yes, now the future contracts can even trade at zero or it can even go to negative prices. So what happened because of this, that the minimum now it could go would have been zero, right? Which means the buyer would be taking a loss of $20 and the seller would be making a profit of $20. But now the biggest problem is because of the lockdown, which is happening all over the world. There is excess supply of crude oil, but there is no demand of crude oil. Now because of that, what is happening is, if you look at the news is that the world could soon run out of space to store oil. So now if somebody is buying oil, they don't even have place to keep that oil. So what they are doing is probably they are renting tankers or whatever to store that oil, which is adding on to their cost. So now people, they don't want to have that add-on cost, because they have entered into a contract, and now if they are not fulfilling that contract, they cannot do that, because as a contract they are obligated to buy that crude oil. Now the challenge, if they are taking delivery of that crude oil, would be that they'll have to now buy tankers or maybe rent tankers, and that is where they'll be storing that crude oil. So now what they tried to do was, because a buyer was obligated to buy, he said, okay, I don't want to buy, but I'm happy giving you, instead of losing $20, I'm happy losing an extra $5, which means I'm happy losing $25, but I want to close this contract, right? Because I'm in this contract, I bought this contract, I want to close this contract. I don't want to take that delivery, but for closing that contract, I'm giving you an extra $5, right? So what that basically translates to is that your actual price went down to -5, because only if it will go to -5, now the buyer is having a loss of $25, and this -$25 would be the profit of the seller, right? Now that seller is getting $25 and both of them can close their contract. So the buyer lost $25, the seller made $25, and the contract was closed, and now the buyer does not need to take the delivery. Similarly, some other buyer might have said, okay, I'm willing to sell with an extra loss, and I'm willing to sell with a loss of, I'm willing to, close my position with a loss of $30, which basically means that the market price would now be -10, right? Because if the market price is -10, only then I can have a loss of $30, which means the seller would be now making $30. So this is what basically happened. It's not that the crude oil in reality went into negative. It's just that these future contracts which were open, the buyers, they wanted to close that contract, and to close that contract and not take the delivery, they started taking bigger losses, and while they were taking those bigger losses, the current market price, it went to negative. So it's not that the crude oil actually went negative. Now, just to prove this to you, you can see this is the crude oil contract for May. Why? Because this May contract was getting expired on the 21st of April. So this is the contract you can see which went to negative $40.32. But if you look at the next month contract, because that is where they still don't need the delivery, you still have time for the contract to expire. So if you look at the June contract, can you see the June contract, it never went to negative value. So here it is, your June contract, and you can see the June contract was in a positive territory. It never went to that negative value. So basically, it's not that the crude oil was negative, it's just that the futures contract which were opened, people, they started closing it with a bigger loss, which net made the value as the current market value as a negative value, right? So that is the only way they could have closed that contract. So that was the story behind how futures price for crude oil went negative. It's just the closing of the future contracts. It was not the actual crude oil which went negative. And yes, that's the complete story. So I hope this helped you in I hope this helped you in understanding what happened in the market, why did the future contracts were trading at negative. And yes, if you like this video, make sure you hit the thumbs up button, share it with your friends, and I'll be seeing you again very soon in another video. Till then, take care, trade safe, bye bye.